INMODE stock is trading at about $22 and it has a PE ratio of 10.73, which is considered very cheap. When I look into their balance sheet, they have close to $675 million of cash and cash equivalents. That's almost 1/3 of the market cap. But the main reason why this stock is down is because of significant deceleration in their revenue growth rate. As you can see on the screen, in the most recent quarter, their revenue growth was less than 2%. So in this video, I'm going to talk about whether INMODE stock is a buy or not. In doing so, I'm going to cover INMODE's business model, then the financials, and finally I'll do a valuation. In the end, I'm going to talk about what I'm personally doing with this stock. Let's first look at INMODE's business model. INMODE designs, develops, manufactures, and markets minimally invasive aesthetic medical products based on its proprietary radio frequency technology. It sells machines like the ones that I'm showing on the screen. So what do these machines do? They're addressing the treatment gap between laser procedures and plastic surgery. As you can see on the screen, on the left we have laser procedures. Almost 40 million procedures are annually done worldwide. They are non-invasive, in-office and topical procedures. On the right side we have plastic surgery. Almost 2.5 million procedures are done annually worldwide, and it's a full surgical procedure with general anesthesia. What INMODE is saying that they have come up with machines that can do something in the middle. And it caters to people with age range between 35 and 60 years. And it caters to the people who are looking for comparable results to plastic surgery, but without the shortcomings of full surgery, including anesthesia, downtime, and scars. So who do they serve? Their major customers are 100,000 plus surgically trained physicians in the US and 200,000 plus surgically trained physicians globally. So INMODE sells their machines to these surgically trained physicians. So these physicians can then cater to the 35 to 60-year-old population who are looking for some aesthetic procedures. You can typically see these machines in gynecologists, ophthalmologists, plastic, dermatology, aesthetics, and ENT doctors. So INMODE sells these machines to these surgically trained physicians and make money. Almost 85% of their revenue comes from this one-time sale of these machines to those physicians, and rest of the 15% is from consumables of these machines. When a physician does a procedure to their customer, right, it requires some consumables, and those consumables are also sold by INMODE. So the consumables business is kind of like a recurring business, because as the physicians conduct more and more procedures, they would need more and more consumables and they have to order them from INMODE. But at the moment, 85% of their revenue is coming from one-time sale. And in order to get revenue continuously, they have to find more and more physicians to sell these machines. So that's one thing that I want you to remember. Let's now move on to the financials. I'm going to show you the results of the most recent quarter. The revenue for the most recent quarter is about $123 million, and that's an increase of 2% year over year. So that's a significant deceleration in their revenue, which is why the stock has not performed well, right? And when you look into their operating margin, that's 38%, which is extremely impressive. This is an extremely profitable company. The way they are getting this kind of margin is because they have very high gross margins on these machines, 83 to 85%. INMODE's net income is also very impressive because they barely pay 10% corporate tax to Israel government, because they are located in a low tax zone within Israel. When I look into the number of outstanding shares, they were 84.8 million a year ago, and now they are 85.9 million. So there isn't significant dilution. There is some dilution, but it's not significant. In the most recent quarter, their revenue from consumables was about $18 million. That represents 14% of their total revenue. With respect to guidance, a few months ago, INMODE said they can achieve between $500 million and $510 million in 2023. But just a few weeks later, they have reduced their guidance. They're saying, we're not going to get 500 to 510 million. Instead, we're going to get anywhere between 485 million to 495 million. So that has also upset the investors. Before I move on to the valuation, I want to clarify that this is not financial advice. I'm not qualified to give financial advice. I'm simply recording my thoughts about INMODE. In this valuation, I'm going to show you two cases. One is a bull case. The other one is a bear case. In the bull case, as you can see on the screen, in 2023, they're saying they can get close to $490 million of revenue, right? Until few quarters ago, this company was growing in double digits. So I'm only assuming 5% revenue growth rate in the bull case, just to give you an idea of what 5% revenue growth can do. With 5% revenue growth year over year for the next 5 years, they can make about $630 million of revenue in 2028. So there's a typo there. Read 2027 as 2028. With a net profit margin of 38%, they can make close to $240 million of net income in 2028. I can happily pay a multiple of 25 for a company with this kind of margin and this kind of balance sheet. With that, their market cap in 2028 would be about $6 billion. I'm assuming 1% dilution year over year, with which they'll have 89 million outstanding shares in 2028. When I divide the $6 billion of market cap with 89 million outstanding shares, I get a stock price of $67. That's about 200% gain in 5 years, or a 3x, which is extremely impressive. That's a multi-bagger, right? And this is with the assumption that their growth rate would be 5%. The basis for this bull thesis is that even though they grew their revenue by 2% in the most recent quarter, once the interest rates come down, more and more physicians can buy these machines because these machines are expensive, right? And physicians may be hesitating to buy these because of the high interest rates. So that is one of the point. And then the bulls are also saying that as the interest rates come down, more and more people who are in the age between 35 and 60 will get these procedures done from the physicians, thereby increasing the consumables revenue for INMODE, right? If that really happens, this 5% growth rate is easily achievable, and a 3x is very easy in that case, right? Let me now show you the other evaluation, which is the bear case, in which we're assuming negative 5% growth rate in the next 5 years. If that is the case, with a multiple of 15, the stock price in 2028 would be about $24. Currently, they're at $22, right? So that's about 10% gain. Obviously, there is a cash component. They have close to $640 million of cash, right? And when I divide that with close to 90 million outstanding shares, that's an additional $7 addition to this stock price, right? So I'm not even considering that. So if you are in the bear camp, we're not looking at a good return, and therefore it's not a buy. Personally, I'm in this bear camp because, in my opinion, a lot of people during the pandemic, they have got these procedures done, and a lot of physicians bought these machines, and I think there aren't many physicians left who are interested in this, because during the pandemic, people had a lot of spare cash and they wanted to get these procedures done. But since these procedures cost anywhere between $7,000 to $10,000, not many people would go for this, in my opinion. I could be totally wrong, but this is my opinion. And in my opinion, the revenue for INMODE will decelerate significantly in the coming years. I'm showing minus 5% here, but I think it's going to reduce further, even less, thereby giving a substandard return or even a loss in 5 years. So this is my opinion. If you are in the bull camp, in which you think INMODE can reaccelerate their revenue, then a 3x is easy. But if you are on the other side, like me, in the bear camp, where you don't believe that they can reaccelerate, in fact, their revenue would significantly decelerate, then this is not a buy. Let me know your thoughts in the comments. Thanks so much for watching.